Hi, welcome to On the Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. Thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So in the past few years, artificial intelligence has captured the attention of investors around the world, delivering really strong return to investors, but also changing the way how we do business. Now, there have been some concerns recently with whether this AI development is turning into a bubble, and many people would compare this with the late 1990s when the internet .com boom turned into a bust. So in this episode, I'm delighted to be joined by Stephanie Aliaga, our global market strategist based in New York, to share with us a bit more on her view on the development of AI, as well as what does that mean for investors across Asia Pacific. So Stephanie, welcome to the podcast.
Thank you, Tai. It's great to be here.
There's been a lot of talk about the circular relationships between AI model developers, hyperscalers, and also the chip companies. Now, in your view, does this interconnectedness signal any risks of an investment bubble, or are we seeing something fundamentally different from past tech cycles?
That's exactly the question on a lot of investors' minds right now. And it makes sense. We've had a significant wave of performance in these AI-linked companies over the last just couple years. And given where valuations are today, where concentration is today, and the memories investors have of the last time we lived through such a major platform shift in technology, we know how that story ended. And there are some flavors, some similarities that we're seeing in today's AI build-out. But there are some very important distinctions. Now, first, let's just talk about what we did see in the late 1990s that people are drawing comparisons to. One of those things that amplified the bubble was what is often called the vendor financing loop in telecom. Essentially, telecom firms were extending loans to their customers who then used that money to buy their services. That created this illusion of booming demand, but that demand wasn't organic. And once credit tightened, that loop unraveled quite quickly. Now, what we're seeing today is there is circularity in AI. The barriers to entry are really high in this AI race. So the ecosystem is small. The number of names that we're talking about here are quite limited. And so the same companies that are consequential in providing advanced AI hardware are those key suppliers in the AI infrastructure build out. They also have a lot of cash. So they're turning around and they're also investing in some of the other pieces of the AI value chain to help facilitate the broader build out of the AI ecosystem. And then you have the model labs, the companies that are developing these LLMs. They see where adoption is going. It's exploding where it is today, but we're still in the early innings. And so it knows for these companies to have the ability to service the kind of AI adoption that they're anticipating in the next couple of years, they need to make plans today to get that supply on board. And to do so, they need to coordinate along the AI value chain. So that's, in essence, what we're seeing by the nature of these AI deals that have been announced. But a key difference here is in what this circularity represents. It's not an issue of inflating demand that isn't there, because in contrast to the .com build out or the .com era, where in 2002, at the peak of that build out, only 7% of the fiber optic network was actually being used. It took years for the adoption of the internet to eventually absorb that excess supply. Today, data center utilization sits near their operational maximums, and vacancy rates in data center real estate are at their historic lows. At the meantime, demand for compute is exploding as we're all using AI more and more, and we're bringing into the real world and giving it harder things to do. So exploding demand for compute and already really tight supply is a key distinction to this AI build out versus what we saw in the .com era.
Now, many of today's big AI investment are coming directly from the cash flow of major tech firms rather than relying on outside financing. How do you think this shift in funding affects the stability and the long-term prospects of the artificial intelligence industry?
That's a really important point because the way this AI investment wave is being financed looks very different from past tech cycles. Now, going back to the dot-com era, most of that investment was funded by debt and equity issuance from companies with very limited cash flow and still unproven business models. Today, it's the opposite. The firms leading this wave are already amongst the most profitable in the world. They have strong balance sheets, very experienced management teams, and are largely using their own elevated free cash flow to fund AI expansion rather than relying on external credit. So it's investment built on top of pretty robust balance sheets. Now, we have seen some large players tap bond markets, and that's worth noting. Roughly $1.2 trillion in commercial debt globally is now tied to AI infrastructure, but most of that is still concentrated in pretty high-quality issuers. So when some of these major hyperscalers raise debt, it's typically a strategic move, taking advantage of low borrowing costs or diversifying their funding sources, not because they're straining for capital. There are a few firms, though, down the stack that have leaned more heavily on credit markets to finance their build-out. But even there, debt has largely been issued at investment-grade levels and is supported by cash-generative cloud businesses. So altogether, this makes the current investment wave more resilient in two key ways. Historically, bubbles have tended to burst when credit conditions tighten. Because this one isn't overly dependent on leverage, it's far less vulnerable to that kind of funding squeeze. And at a macro level, it's proven surprisingly steady, continuing at pretty robust rates, even as nominal growth in the US has moderated and rates remain relatively elevated.
Unlike the early days of the internet, it seems that AI companies are finding ways to generate revenue as they build. So I think there's a really big contrast to some of the dot-com companies back in the late 90s. What are some of the most promising ways you're seeing AI drive real business value right now? And do you think this growth is sustainable? And also, what type of other technology can complement AI in order to further along this development?
That's another really key point, because what's unique about the cycle is that monetization is happening alongside the build-out rather than years following it. On the platform side, you're seeing that AI is driving incremental demand for cloud services in real time. As companies accelerate their AI strategies, they realize they need more compute power and cloud capacity to train and deploy models. That demand is showing up immediately for these cloud companies. At the same time, those same firms are using AI to enhance their core businesses, whether it's by improving ad targeting, automating software development, upgrading their own enterprise productivity tools. They're not just selling AI capacity, but actually using AI internally to strengthen margins and productivity. Now, looking across the broader business landscape, adoption is also tracking quite well. Only about 10% of US firms say to the census that they've formally integrated AI into production today. But that share has been gradually rising over the last few years, and we think adoption is beginning to deepen as well. If you look at KPMG's latest AI Pulse survey, which looks at US firms that make over $1 billion in annual revenue, you can see that AI agent deployment has jumped from 11% to 42% of organizations, and that's just this year. The average investment plans amongst these companies has also grown to $100 million per firm. Now, these aren't speculative bets either, but have been informed by some pretty promising success so far in productivity and profitability use cases for AI. Now, some of the tangible examples that we're seeing of that, professional services, companies are using AI co-pilots for legal drafting, contract review, compliance monitoring, and healthcare AI systems are assisting with radiology interpretation, documentation in doctors' offices, and freeing up physicians for higher value work. And in software development, AI coding has been a killer application, helping coders or engineers write and debug code much more efficiently. Now, business adoption is not going to be a straightforward process either. And the real onus here is on organizations themselves. I mean, how do you reimagine and reconfigure workflows so that you can better distribute your human capital to complement, orchestrate, and optimize these AI agentic systems? Once those systems are properly trained and built, which is also going to take a lot of time, it's going to take proprietary data, and you're going to need the right human orchestration every step of the way. So, we may see a little bit of 2 steps forward, 1 step back in this adoption cycle. But when it comes to the broader AI wave, I think the key point here is that the monetization is there, and it shows that we're still really at the low-hanging fruits of AI use cases.
We're hearing that demand for computing power in data center space is at an all-time high, while supply in data center space and also in some cases, power generating capacity is struggling to keep up. What do you think could change this balance, or is there a risk that we may actually see overcapacity in the future as we did see in the previous tech booms?
Right now, the binding constraint is really supply, not demand. As we talked about earlier, data center utilization is at its maximum, operational peak, and vacancy rates are at their all-time lows. And also just the fact that our demand for compute is exploding right now. I mean, more data has been created in the last 3 years than in all of human history combined. And as we bring AI into the real world, as we use it more, and we introduce it to the complexity and the nuance that is real life, we're forcing these models to think for longer. And as these models, reason, it requires a lot more compute. In fact, there are estimates that it could cost 100 times more compute when you give these reasoning models pretty challenging queries than the traditional single-shot inference models of the recent past. So that's the demand picture right now. It is growing exponentially as adoption grows and deepens. Now, what could change this balance, to your question? There's three key things that come to mind. One, a macro shock would absolutely be disruptive, particularly to business tech budgets, their willingness and ability to invest in technology and the deployment of AI. Second, energy is a big potential bottleneck here. And if we see more blackouts potentially hit the grid in the US, or just this continued climb in electricity prices create a social or regulatory backlash, I mean, that could potentially really stunt AI development and deployment. It's going to take us years, in fact, maybe 2030s at best, to get a material amount of new energy onto the grid. In the meantime, we're going to really have to rely on renewable energy like solar, wind, battery technologies, getting better at utilizing the grid, getting more efficient at energy. But there's, a lot of policy changes that have happened that are stunting some of our progress in relying on those sources of energy supply. So a lot of unknown there. And then third, let's say we get the math wrong. What if the useful life of these GPUs are actually much shorter than we expected? Let's say they are 2 to 3 years as opposed to the 5 to 7 years currently penciled in. That could really challenge the economics and the return on investment timelines that we have or are expecting across the AI ecosystem, potentially forcing a pause. But I will say the risk of overcapacity in the near term seems far limited relative to the risk of undercapacity, which is why you're seeing all of these deal announcements being made and this rush to align incentives across the value chain to try to get the supply on board that we need. I think the risk for investors is really around timing. How much more investment do we need, and when will the ROI begin to materialize? And what if something does break along this AI path, as it may well? Are portfolios positioned to weather the potential for that kind of volatility?
Now, looking back at the previous technology bubbles, what lessons do you think investors should keep in mind as they navigate the current AI landscape? How can they distinguish between companies with real transformative potential and those maybe overhyped?
That's a great question, because the AI race today is widening quickly, and not all that glitters is gold. So first, I'd say focus on fundamentals. While I've mentioned how the fundamentals behind this wave are much stronger than what we've seen in prior tech booms in a general sense, not every company tied to AI or benefiting from AI enthusiasm shares the same balance sheet strength, business model, or visibility around its competitive moat. Being early in the markets can be the same thing as being wrong. So focusing on fundamentals and earnings visibility should do investors well. And second, history teaches us humility. Early in any platform shift, it's hard to identify who those ultimate winners will be. During the internet era, we didn't have that great of visibility into, the who was going to ultimately win the search wars, what kind of gig economy companies would come out of the establishment of the internet, and how long it would take for all of us to start online shopping. So we need to take those lessons to today. AI is going to be transformational and disruptive to a lot of the incumbent businesses we have today. So while today's incumbents look dominant, most can shift quite fast. And third, despite all of this talk around an AI bubble, I think the biggest risk for investors is the AI boom a house of cards, but rather who is left holding the winning hand. Some of these companies will deliver on their potential, but others may fall short of the valuations being priced in today. And that's why we think diversification and active management are so critical. Not every part of the AI ecosystem is going to succeed at the same pace or rate. And lastly, keep in mind that AI is a global story. We've talked mostly about the US here. You have me coming from New York, but I know my audience is not necessarily US based. So I think taking a close eye at the acceleration in AI that we're seeing across Asia and Europe as well is going to be really important for investors to stay diversified in portfolios. But in short, stay humble, stay balanced, and stay invested. But let fundamentals, not fear or euphoria, drive decision-making in portfolios as this AI story unfolds.
So Stephanie, thank you for joining us today, and we look forward to have you on our podcast again soon. And also thank you for listening, and I hope you find this podcast useful. If you do, please share this with your colleagues and friends, and of course, consider subscribing. If you have any questions that you want us to address or answer in the future, feel free to reach out to your JP Morgan Asset Management client advisor. I'm Tai Hui. I'll see you in the next episode to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.